Have you ever set up a living trust and wondered how the IRS actually sees it? I mean, is it a separate thing or is it you? It's a fantastic question, and the answer is surprisingly dynamic. So, in this explainer, we're going to follow the journey of a living trust's tax identity through its entire life. Okay, let's dive in. So, here's the central idea we're going to explore. On one hand, your living trust is a legal powerhouse, right? It can own your house, your accounts, and help your family avoid the headache of probate. But on the other hand, to the IRS, for most of its life, it's basically a ghost. So how can it be both at the same time? Well, that's exactly what we're about to unpack. All right, let's start with phase one, which is usually the longest part of the trust's life. While the person who created the trust is alive and well, it has this really fascinating dual nature. I like to call it a phantom trust. It's totally real in the eyes of the law, but for tax purposes, the IRS looks right through it. And understanding this one concept is the key to everything else we're going to talk about. And this slide just nails that duality. See, under state law, your trust is a legitimate legal entity. It can hold the title to your home, your brokerage accounts, you name it. But under federal tax law, it's what's called a disregarded entity. I love that term. It means the IRS literally just pretends it's not there and looks straight through the trust to you, the creator. Now, the official IRS name for this phantom is a Grantor Trust. And it all comes down to one word, control. Because you, the grantor, can change it or revoke it anytime you want. The IRS just says, hey, this is still you. So all the income, all the deductions from assets inside that trust, they just flow right onto your personal Form 1040, almost as if the trust didn't even exist. Okay, so if the trust is just a tax extension of you, how does it identify itself when you go to open a bank account? This is where so many people get tripped up, but the rule is actually super simple, and it's designed to make your life way easier. You know, the IRS actually makes this part pretty easy. As long as you, the grantor, are alive, any account that's titled in the name of your irrevocable trust just uses your own Social Security number. That's it. No special tax ID, no extra forms. The income is reported under your SSN, goes on your personal tax return, and the whole process is seamless. And yet, I bet a lot of you have heard this exact line from a bank or a brokerage. It is such a common roadblock. The person at the bank, probably just following some outdated internal checklist, insists that you need a separate employer identification number, or an EIN, for your trust. Well, this is why it pays to know the rules, because the bank in this case is just plain wrong. There is a specific IRS regulation, you can see it right here, that explicitly says you can use your SSN. This isn't some secret trick, it's the standard official procedure. So the big takeaway is you can confidently and correctly tell them to look it up. All right, now let's tackle another really common point of confusion. What happens if the person who created the trust, the grantor, becomes incapacitated and can't manage their own affairs anymore? Does the tax status of the trust suddenly flip? So here's the myth. A lot of people think that incapacity automatically makes the trust irrevocable and means you need to rush out and get an EIN. But the reality is very different. You see, for tax purposes, what matters is the power to revoke. And even if the grantor can't personally use that power anymore, the power itself still legally exists. So the trust almost always remains a grantor trust. So let's just break it down for this phase. The trust is still a grantor trust. The successor trustee, who's now in charge, just keeps using the grantor's Social Security number for all the tax reporting. No separate trust tax return is needed. The only time this isn't the case is if the trust document itself has some rare clause saying it becomes irrevocable if the grantor is incapacitated. Okay, now we arrive at the big one. The moment everything changes permanently, the instant the grantor passes away, the rules flip. That tax ghost we've been talking about, it suddenly materializes and becomes a brand new, totally separate taxpayer in the eyes of the IRS. Think about it. The power to revoke the trust dies with the grantor. That is the critical turning point. The trust is now set in stone. It's irrevocable. And from this moment forward, the IRS no longer disregards it. It stands on its own 2 feet and begins its own separate tax life. So, because it's a whole new taxpayer, it needs a new tax ID. The grantor's Social Security number is officially retired for the trust's purposes. The trustee's first job is to go to the IRS website and apply for an Employer Identification Number, or EIN. This EIN will be the trust's permanent ID for all its future bank accounts and tax filings. So why is this transition such a huge deal for a trustee to manage? Well, this chart shows you the tax trap perfectly. Look at this. For an individual to hit the top 37% tax bracket, they have to earn over $600,000. But a trust? It hits that exact same top tax rate after earning just a little over $15,000. This is called compressed tax brackets, and it means if a trustee isn't smart about distributing income, the IRS can take a huge bite. It makes post-death tax planning absolutely essential. Now that the trust is its own taxpayer with its own income and its own ID number, it gets a new responsibility, filing its own tax return. This is done on IRS Form 1041, which is the specific tax return for estates and trusts. This is a massive change from the pre-death phase we just talked about. So when do you actually have to file this thing? This table lays out the triggers pretty clearly. You have to file a Form 1041 if the trust has $600 or more in gross income, or if it has any taxable income at all, even a single dollar. And that first rule is the one that trips people up. It's based on gross income. So even if the trust lost money after expenses, if it brought in $600 in dividends, you still have to file. Now, filing separate tax returns for the trust and maybe also for a separate probate estate can get really complicated and expensive. But thankfully, the tax code gives us a really powerful tool. It's called the Section 645 election, and it can make a trustee's life so much simpler after the grantor's death. So how does it work? It's actually way easier than you'd think. The person in charge of the will, the executor, and the trustee of the trust just have to agree. Then they jointly file one simple form, Form 8855. And just like that, for tax purposes, the trust is treated as part of the estate, and all of its income and expenses are reported on a single tax return. And the benefits here are huge. First, consolidated filing, one return instead of two. That saves time and money right there. But the real power is that estates can choose a fiscal year end. They're not stuck with the calendar year. This gives you amazing flexibility to defer taxes. Plus, you get a 2-year holiday for making estimated tax payments. For a trustee, this is an absolute game changer. So let's just pull it all together. This little chart really summarizes the whole journey beautifully. While the grantor is alive, whether they're competent or not, it's a grantor trust. It uses their social security number, and everything just goes on their personal Form 1040. Easy. But after death, it instantly becomes an irrevocable trust. It needs a mandatory EIN, and it files its own separate tax return, the Form 1041. And that really brings us to the final thought. Understanding this life cycle isn't just some boring tax exercise. It's about being prepared. Whether you're setting up your own trust today or you know you're going to be a trustee for someone else down the road, you need a plan that's ready for these very different stages. So is your plan ready for the entire journey? Thanks for joining us.